From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for March 28th, 2025. Set the Wayback Machine to 1980. Blue Oyster Cult is at the Pabst Theater tonight. The Bucks have 3 home games this week and Monday opening day for the Milwaukee Brewers. The first one in 50 years without Bob Uecker. The Uke will be missed. All right, 2 British men were found guilty of stealing a $6 million solid gold toilet from Blenheim Palace. That's the country estate where Winston Churchill was born. Good thing they were caught, or they probably would have peed away those $6 million bucks. A couple of young employees at a truck stop in Tennessee felt threatened when 4 men entered the truck stop carrying 2 pythons and placing them right on the counter. The workers let the snake charmers take whatever they want, including $400 in CBD oil and a bunch of munchies. No charge, guys. Don't forget to take your snakes with you. The cops were called on St. Patrick's Day to an airplane landing at LAX. It turns out a passenger had just bitten another random passenger. And no, it was not Dracula, it was St. Patrick's Day. And the last story reminds me of a newspaper item from several years ago. The headline read, "Missing drunk man spends hours helping a search party look for himself." On the podcast today, we have Dave Sandstrom, Adam Bailey, Joel Driesing, and to start us out, here's Kyle Tedding.
That last one hit a little late for me, Max, but a wonderful headline. We are pre-recording this podcast just a little early, given a lot of spring break in our area. But as a result, there'll be no closing numbers. But thought it would be a good opportunity to just take some time and talk about market volatility more broadly. It's a topic I think that's incredibly important, given everything we've dealt with over, really any number of time periods. Anytime we seem to face some uncertainty, it appears as if markets are kind of set adrift. We bring back phrases like animal spirits, right? This idea that investors are now driven more by emotion than they are any kind of fundamentals. And I think that makes some sense, right? That absent clarity on where the fundamentals are headed, you tend to just set things adrift. You tend to let maybe the emotional response drive some of your decision making. And I think it's also where we can get ourselves in some trouble, Adam, right? That perhaps just because we don't have clarity doesn't mean that, well, now's the time to assume that something different needs to be done.
I really like how you phrase that. Absent clarity on the fundamentals. It's the animal spirits that take over. Animal spirits like fight or flight or fear and greed. I mean, those are the ones that really play out in the world of investing. And people tend to get in when they feel good, they get out when they feel bad, and that lends itself to buying high and selling low, and that usually doesn't play out well in terms of investment strategies. And there's been a lot of emotions to go around so far this year, maybe more on the fear side than the greed, but it's created a lot of volatility as we've started this year.
Dave, no shortage of history on market corrections, no shortage of things we can point back to. There's always a danger in just assuming that it's going to look like the last one, just like there's a danger in saying this one's going to be different than the last one. But I think history does give us some idea of what are the right ways to navigate volatility. How do you kind of walk clients through, here's what to expect, here's what we're kind of dealing with, and most importantly, here's what we should do about it?
Kyle, I always talk to people about having a good, solid plan in place. Because every investor is different, their goals, their needs, and they need a custom plan. You have to make sure that all of your short-term needs are covered. You want to make sure that your long-term planning is in place. And I think if you find yourself in a situation where you are completely uncomfortable, scared to death, can't sleep at night, then there's a high likelihood that your plan is not right for you, and it needs to be addressed. Because if your plan is correct and you have taken all those things into consideration, the amount of risk that you should be taking, make sure your short-term needs, then you should sleep at night. You should be able to, I understand volatility. It's part of the game. It's part of investing. And my plan is developed just for me. It matches my needs, and then you should be able to put up with that. So I would say if you are feeling highly uncomfortable, that it's a good time to reevaluate your plan.
Balance remains the best antidote to uncertainty and volatility, and making sure your plan, your investment plan, your mix of stocks and bonds fits your tolerance for risk and tolerance for volatility. It really gives you the ability to have courage and confidence to hold on through times of heightened volatility, but it gives you the patience then to ride them out and not react to those animal spirits of both fear and greed.
So you're talking about balance and a plan to help people. Are there intrinsic values that people have that you've noticed over time that in which they're a little more chill when it comes to volatility in the market when a lot of other clients might be calling up and concerned? I mean, is it a matter of age or wealth or dispositions?
I was going to say experience, but maybe this one goes with age. I've had the pleasure doing this now I've been here 24 years, so a lot of my clients have been with me for many, many years, and during periods of market sell-offs, it ain't their first rodeo. You know, they've seen how this worked in the past. They know how balance gets them through that. They know how patience works to ride this out, and maybe I'll put some meat on the bone for this one in terms of volatility that we experience. In the last 45 years, we have had an average intra-year drop of about 14% per year from peak to trough every single year for 45 years. And in those 45 years, even with sizable drops, market's been positive 34 out of 45, and rarely ever do we finish at the lows for the year.
Joel, I'll add that some of my favorite conversations are clients calling up nervous and going, I already know what you're going to say. I already know what you're going to tell me. You're going to tell me that everything's fine and that, this is going to pass like everything else. And sometimes, yeah, I don't think it's always that everything's fine. I think it's, Dave's earlier point that we started with a plan. And unless you are telling me that something is fundamentally different, and of course the problem that we're really getting back to in all of this is that in the middle of all this, you don't really know if something is fundamentally different. But unless you're telling me that something's fundamentally different, the plan is the same. And yeah, we might have some opportunity to do something a little different. Maybe your life's a little different. You need a little more cash now or a little cash now than you did the last time we went through this. And we try to plan ahead for those things as much as possible. But more than likely, if you've been doing this, especially doing this with us for a long time, as Adam was talking about, we're calling you because we know you're going to be nervous. We've reached out to say, hey, here's what's going on, whether it's through an email, through the podcast, through the newsletter, where we're talking about those very things and talking about this is why we do what we do. This is why that education is so important. Or whether it's our clients picking up the phone and calling us and saying, hey, I'm nervous, but I know what you're going to tell me and I know it's going to be okay.
And that's one of the things I appreciate. What Dave said is just sort of realizing that individuals can feel differently at different times, and sometimes we change our minds. Sometimes our own circumstances, besides what's going on in the markets or what's happening in the world, we do sort of change our mind, and it's nice that people feel that they can call in and say, hey, walk me through this.
And we also change our mind after time has passed and we look back at periods of volatility. And I just want everybody to take a moment and maybe ponder the silliness of this. We're in the middle of volatility. We feel like, oh, this is a risk. Oh, I should get out of the way. But then 2 years down the road, you look back at it, that same period of volatility, and you don't see it as a risk anymore. Now you say, oh, what a great buying opportunity that would have been, right? Just spend a moment trying to think through that.
And Dave, I think there's this tendency to want to react, right? To want to do something. And sometimes that can give you some peace of mind, but it also can be costly, right? It also can lead to making some poor decisions because you are acting in an uncertain environment. And we've got plenty of data going back, decades now of what's it cost when we take that action, what happens if we miss out on just a little.
Kyle, and that brings you right back to it's time in the market and not timing the market, which is critical. And Kyle, what I think you're kind of referring to is you look at how, this just speaks to volatility, I guess, but if you were to miss just the 10 best market days in the last 30 years, you're talking about maybe missing out on that 30-year performance by about 50%. So it isn't easy. It's actually impossible to time those market swings. So again, that's the how critical it is to be comfortable with your plan so that you don't get to that point of discomfort that you're going to make a really bad decision, which typically happens right about the bottom is when most people decide it's time to bail.
And investors need to remember that those 10 biggest days, even if you miss those 10 biggest days always, always, always come after the 10 biggest down days.
Yeah, and I think that's really the key in terms of why we stay invested and why it's so difficult to time is not only are they coming when things feel bad, not only are the good days coming when things already feel bad, but they're coming in quick succession. And so you don't just have to be right in selling, right? If that's what we're talking about is let's get out of the way of the bad days, you got to be right in when to get back in. And I don't know about you all, but it's tough enough to be right once on that kind of stuff. To be right twice gets, well, at least twice as tough. And of course, I think that's why what we keep talking about is have that plan, stick to that plan. And if you're not comfortable with the plan, then it's a different conversation. The problem in all the data is, and I'm a big kind of proponent of things like science communication, and one of the things you learn in listening to a lot of science communicators is you don't replace bad information with good information. You replace a bad narrative with a good narrative. That the story carries a lot more weight for the individual than the data itself. And so we can point to, yeah, the 10 best days come right after the 10 worst days. And yeah, if you miss out on those 10 days, it's 50% of the return. But I think the data points themselves are helpful. It's the narrative, though, of here's why we do what we do that becomes really the thing that carries investors.
And let me change the narrative just a little. We've been talking about volatility. And the way our industry defines risk in one way is volatility. A variation around the mean. We actually have a technical term for it. It's called beta. But essentially, it's volatility. And volatility is a double-edged sword, both on the upside and on the downside. And I don't think anybody would say risk is the chance of unexpected gains. No. I think we would all define risk as the chance of loss, not unexpected gains. And I've always been uncomfortable with the way we define risk as volatility because I don't see it that way. I view risk differently. And risk for me is called permanent impairment of capital, right? Not volatility. And if you keep your mind focused on that, and for most investors, like permanent impairment of capital is not meeting your objectives in your financial life or going broke before you die. Like that's permanent impairment of capital. And when you start to view risk that way, you have more patience to ride out the ups and downs. You tend not to overpay for assets because, my goodness, you pay $100 for a stock that's only worth $50. Well, half your money's gone for good, and ain't ever coming back. And it tends to add to more patience and understanding and riding out those ups and downs.
I think it speaks directly to the role that stocks can play in the long-term success of an investor, as long as you're willing to stick to the plan. I think we've talked around this plan, but Dave, one of the pieces I always want to come back to is just the fundamental concept of what gives us the confidence to stick with those stocks? What's necessary for a portfolio? What's necessary for the investment plan to be certain that it's going to be okay, or at least to be certain that we're going to be taken care of for a long time to come back to where we think we're supposed to be?
Well, Kyle, obviously you want to have something in the portfolio that is not going to behave like the stocks, and typically and traditionally for us that's been bonds in the portfolio, some type of fixed income asset that hopefully is going to have a negative correlation over the long run to that stock portfolio. And we always like to say to clients that, a bond portfolio can give you the confidence to own stocks and the courage to own stocks. And a lot of the philosophy behind the balanced portfolio, typically that 60-40 portfolio, we would typically recommend a spending percentage of about 4% a year, somewhere in that 4 to 5% a year. And when you think about it, if you have 10%, if you have 40% of your portfolio in bonds, that's going to give you a good 10 years of spending from your bond portfolio where you don't even have to worry about those stocks and where they've gone and what that volatility is. And to put some perspective on that, the longest we've ever had to wait for a market recovery from a peak to the bottom back to that prior peak has been about 7.5 years in the 1970s. And so even as something as deep and painful as the Great Recession was, we're looking at 4.5 to 5 years before the stock market recovered. So during that time frame, if you had a very strong and appropriately positioned bond portfolio, you got through that time frame without any problem.
Yeah, just to add on about volatility, maybe not on the bond side, but just in terms of stocks. Volatility is the norm in the stock market. Volatility is to be expected. It's okay. That is the norm. And just a reminder that to put up with all of the volatility, that is the reason why you get paid so handsomely to own stocks. And that's also why you need to have a meaningful amount in bonds just to buffer against all that volatility. But it's the reason why you get paid so handsomely to own stocks is to put up with the ups and downs.
I think those are all great points. I think we talk about plan, we talk about how we can get to that reward, Adam, that you're talking about for putting up with the volatility. And of course, Dave, to one of your earlier points, I think the challenge is that sometimes we find out investors just didn't understand the risk they were taking. Through no fault of their own, through no fault of whoever it was that was helping them put together, it's just some environment that proves to be too much. And in those places, the plan has to change. And I think that's always the question we get last is, well, what are we going to do different? And to me, there are only two things that lead to change in portfolio. The first is the one that we were talking about just now, that something about the current environment causes you angst, causes you unease, causes you to lose sleep. But the second is a shift in the fundamentals. If there is something drastically different about where we're headed than where we were, then we need to do something to change that. The biggest, example I have near term is we went through a 10-year stretch or a 10-plus year stretch where interest rates were basically zero. And we're now in an environment in which interest rates are higher. Well, that to me is a fundamental shift in the relationship between stocks and bonds. It means we have to reevaluate how much of our portfolio we should be allocating to one versus the other. Other examples, change in lifestyle, change in life situation, change in need from the portfolio. Those are all environments when we want to make change. The environment I don't see a need for change is uncertainty. It's the one time in which uncertainty alone tells me nothing. It's the absence of information, not the presence of information. And I need information in order to make decisions about where we should go. And so I think these are the points in time in which you have to trust the plan. You have to understand that volatility is the price we pay for the returns we hope to get from our portfolio. And until such time as we understand how fundamentals have shifted, maybe we tweak here and there, maybe we take advantage of some little deals, some little opportunities. But the right thing to do is to stick to the plan. The right thing to do is trust that we probably had it right to begin with. And if we had it wrong, we built in enough cushion, we built in enough safety within the portfolio to ride out whatever storm is coming next. And so I think, the risk of all of this is that we allow the emotion, we allow the animal spirits to drive decision-making rather than coming back to the fundamentals, coming back to those things which we know long-term are the reason we invested in the first place. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.